If you don't understand how a business creates value, then no amount of analysis is going to help you. Stocks are ownership, and ownership demands first principles. So today, that's where we're starting. Let's find some value. Investing often seems risky and mysterious, but in reality, it's far less dangerous and far more understandable if we approach it from a fundamentals-based perspective. What do we mean by that? Well, at its core, long-term investing can be broken down into two simple but very powerful questions. 1. How good is the business behind the stock? 2. What price are we willing to pay for it? This two-part framework of business quality and price is the foundation that's been used by the most successful long-term investors. And importantly, it's the same framework regular people like you and me can apply without needing to predict the future, time the market, or react emotionally to news. In this episode, and over the next couple of episodes, we'll be focusing on part 1 of that framework. How do we evaluate the quality of a business? And what we're going to try to do as much as possible in this series is build our framework from the ground up, from first principles. And this may seem tedious, but it's super important because if we can't be aligned on the most basic ideas, like what is a business, what is the purpose or mission of a business, how do we define value, if we can't be aligned on these basic things, then anything we build on top of them is going to be unstable. Alright, so with that, let's get started. And let's start with the first principles by defining what is a business. A business is an organization that adds value to society by providing goods and or services to people or other organizations in exchange for money. Now that last phrase, in exchange for money, is critical because it will allow us to be precise and objective about our definition for value. Now before we get to our definition of value, let's quickly address some objections people may have to this definition of a business. The first objection people may have is that not all businesses provide goods and services in exchange for money. That is true. There are nonprofit businesses that provide value to society without charging for it. But for our purposes, which is to invest in publicly traded companies, we're going to limit our definition of a business to for-profit businesses. There are no businesses that are nonprofit and which are also traded on the public exchanges, and therefore they fall outside of the scope of what we're trying to analyze here. So for our purposes, business involves an exchange of goods and services for money. The next objection someone may have to our definition of a business is that businesses don't necessarily have to provide value or benefit to society. Some businesses simply extract money from people. This objection often comes from a more adversarial view of businesses, from people who think that large corporations or large companies are generally bad and treat people unfairly. Well, to answer this objection, we can start by simply evaluating the way people actually live in the world. Think about some of the things that you voluntarily pay for: food, clothing, housing, entertainment, communications, transportation. In almost all of these cases, you are choosing to exchange your money for a good or a service that is provided by a business. And you do so because in your judgment, what you get from the business is worth at least as much as the money that you give up for it. If that wasn't the case, if the money you were giving up was not worth what you were getting in return, then very likely you'd go somewhere else. You'd find an alternative. You see, if a business stopped providing value, if its product became inferior or unnecessary or overpriced, people would just go elsewhere. That's the great thing about competition. Healthy competition ensures that businesses have to continue providing value in order to survive. Now that doesn't mean that all businesses are perfect or benevolent, but it does mean that on average, businesses that persist over time do so because they're providing something valuable enough that people are voluntarily willing to pay for. Now someone very stubborn might still object and say, well, hold on a second. There are definitely some examples of businesses that cheat people and extract money from them without providing any value whatsoever. For example, Bernie Madoff's businesses, or the recent Theranos medical case. Well, that's true, but the crucial point is that those businesses were not businesses to begin with at all. They were scams, and scams are fundamentally different from sustainable businesses. Scams rely on deception, and because they rely on deception, they're extremely hard to maintain. They will collapse as the word gets out, as legal systems intervene, and as trust breaks down. And so as investors, we exclude scams from our definition of a business, not simply for moral reasons, but because scams lack durability. They do not create sustainable value over time, which prevents people from engaging with them in the long run, which in turn makes them very unsuitable for long-term investing. All right, so to recap, a business is an organization that provides value to society by exchanging goods and services for money. That's how we're going to define it, and from my point of view, I think we've covered our basis regarding that definition. Now let's move on to value. What do we mean by that? We're going to define value as a total benefit that a business creates in the market. And we can think about that benefit in two ways: the benefit that accrues to customers and the benefit that accrues to the business owners. Let's start with the customers. We can quantify the total benefit that accrues to customers by their willingness to pay for the products and services provided by the business. As we said before, customers and businesses engage with each other voluntarily. Therefore, the value that accrues to customers is simply the price they are willing to pay for what they receive from the business. For example, if I pay $30 for this sweater, that is a sure signal that this sweater is worth at least $30 to me, possibly more. In that sense, revenue or top-line sales is the most objective signal that a company is providing value in the market, and it's also the easiest way for us to quantify that value. All right, so let's talk about the business owners. The benefit that accrues to business owners is the money that is left over from the business operations after it has delivered on its promises to customers and other participants in the business, including employees, third-party vendors, lenders, and so on. This is the company's profits, and the profits are what the owners are left with to do as they please. Take disbursements, reinvest it back into the business, so on. Now this is a bit of a simplification. When we think about value for the owners, we typically think of enterprise value, the total value of the business if they were to sell it. But for simplification purposes, when we talk about certain periods of time and how much value the business has generated during that period of time, profit is a very simple way for us to quantify that. All right, so revenue helps us quantify the total value a business creates in the market for customers, and profits helps us quantify the total value a business creates for owners. Now, someone might object and say that there are many other ways we can measure the value that a company creates in the market, like the number of customers it has, or the number of employees that it hires and takes care of, or the company's net promoter score. Now, that is true. There are many different ways we can measure the value a business creates. But our goal is to create a simple and effective framework for evaluating businesses in general, regardless of their industry, geographic focus, or target market. Different businesses will have varying degrees of net promoter scores, number of customers, number of employees, so on and so forth. Therefore, those data points are extremely important and useful for diving deep into companies and benchmarking them against each other. But for the purposes of identifying high-quality investments in general, the most objective measure of value is top-line sales, the amount of money a company can get people to pay for its products and services, and bottom-line profit, what it gets to keep after that. Both of these together tell us the value that the business creates for customers and the value that the business creates for the business owners. All right. So let's get on to our last first principle, which is often the most controversial. What is the purpose of a business? For this framework, we'll assume that the purpose of a business is to maximize long-term sustainable value creation for customers. Now that's the controversial part, because many people are taught that the purpose of a business is to maximize value creation for business owners. In other words, to maximize profits. Our framework rejects that assumption, and we instead view profit maximization as a necessary goal, but as a secondary goal. The predominant goal of a business is to maximize value for its market. That's why the business exists. Without providing value in the marketplace, the business has no reason to exist. Value creation for owners, or profits, comes from providing value in the marketplace. And therefore, it's a secondary goal, not the primary goal. So as investors, we view the primary purpose of a business as maximizing value for customers in the long run. Now, the key phrase there is in the long run, because what this does not mean is maximizing short-term revenues at any cost. It does not mean ignoring profitability. Instead, what it means is that good businesses focus on serving customers well enough and consistently enough to continue operating, reinvesting, and growing the business over long periods of time. Doing that involves being profitable. In fact, it's impossible to do that without increasing profitability at the same time. So businesses that focus on sustainable value creation in the marketplace tend to generate profits naturally over time. On the other hand, businesses that focus exclusively on profits, especially short-term profits, tend to undermine their long-term value creation. All right, so that does it. That's our first principles. Let's quickly recap them before we start building up our framework for evaluating businesses. All right, so here they are. Here are the first principles we'll be using to build up a framework for evaluating the quality of a business. Number one, a business is an organization that provides value to society by offering goods and/or services to people or other organizations in exchange for money. Number two, the value a business provides is the amount of money people or organizations are willing to pay for its goods and services, as well as the money the business gets to keep after that. These help us evaluate value creation for customers and owners respectively. And finally, number three, the mission or goal of a business is to maximize long-term value for customers. With these assumptions in place, we can now begin to evaluate what makes a good business. First, if the business exists to maximize long-term value for customers, then the first requirement is fairly obvious. The business must actually be doing that. This requirement is so simple, we're not going to spend too much time on it, but we leave you with this thought. If we follow this simple rule, we will have eliminated many businesses from our consideration, especially businesses working on concepts, technologies, products that haven't yet proven their worth in society. This is where Peter Lynch's famous phrase, invest in what you know, comes into play. If you don't understand a product, or you don't know whether it will be valuable in the future, then just stay away from it. It may not be the right investment for you. Now beyond that, the next most important thing is for a company to continue existing in order to maximize value. We want to ensure that under any existential threat, whether it be supplier demand shocks to the core product or service, poor economic conditions, or a changing regulatory environment, we want to ensure that under any such circumstance, the business has the ability to sustain itself without external funding. We're going to refer to this as the safety requirement, and we'll see that we can assess a company's safety by looking at its balance sheet. From an investor's perspective, safety is predominantly about financial resilience, balance sheet strength, manageable debt, strong liquidity, and the ability to fund operations internally. This will be the topic of our next lesson. In our next video, we'll dive deep into the safety requirement. But it's not enough for a business to just be a safe business. A good business is also one that can organically strengthen its position to maximize value. In other words, companies that are safe and that can make themselves safer and also improve their ability to provide value in the market are better companies on average. We refer to this quality as a competitive moat. Moats can come from many different sources, including a strong brand, high switching costs to alternatives, network effects, but quantitatively, they tend to reveal themselves through efficient reinvestment, sustained returns on invested capital, and strong earnings and revenues growth. As a teaser, a lot of the data we can get to assess a company's moat will come from its income statement and cash flow statement. Another way you can think about moat is a company's unique advantage and durability within its industry. In other words, does a company already have a strong position as a value provider in its market? And can we expect it to strengthen that position given its historical performance and current strategy? Dominant players within their industries have strong competitive moats. All right, so that's it. This is our simple three-part framework for evaluating the quality of a business. 1. Does a company already add value in the marketplace in a way that is meaningful to people or other organizations? 2. Is a company financially safe and resilient? 3. Does the company have a durable competitive moat that allows it to grow value over time? In the next episode, we'll be diving into the details, starting with our safety requirement. We'll learn how to evaluate balance sheets from a value investing lens. All right, that's it for this session. Thanks for joining, and we'll see you at the next one.